Hey, I'm Paul Perry,
I'm Kim Hartsock, and you're listening to The Wrap,
a Warren Averett podcast for business leaders,
designed to help you access vital business information and trends when you need it.
so you can listen, learn, and then get on with your day.
Now, let's get down to business. Hi, everyone, and welcome to The Wrap. And today we're talking about what you should know about the Inflation Reduction Act and taxes. And we are very excited to have our guests back with us for a record, I think, fifth time, our tax partners, Lisa Billings and William Dow.
Thank you. Glad to be here.
Yes, glad to be back.
And Lisa and William are going to share with us today what we need to know about the Inflation Reduction Act of 2022, which President Biden signed into law on Tuesday, August 16th. And this bill is a sprawling climate tax and healthcare bill that covers a lot of different things. And so welcome, Lisa and William, to help us understand this bill.
Hey there, I'm Lisa Billings. I'm with Warren Averett's tax division in Birmingham. I work primarily with private equity and real estate clients across the U.S.
Hi, I'm William Dow, a member in the tax division in the Birmingham office. I work with a lot of private equity groups, a lot of large corporations in the corporate tax and the M&A area.
So the good news for most taxpayers is that this act is not designed to increase taxes on small businesses or families making less $400,000 or less. So I know that there are different areas of this tax bill that we really want to talk about today. So let's jump to the first one. And Lisa, William, I think there was something in there about corporate minimum tax. Can you give us an update on that?
Yeah, it's interesting, Paul, that you mentioned that about that it's not designed to increase tax on families making less than $500,000, because what you're going to see is this kind of goes on both ends of the spectrum. The first couple items we're going to talk about really apply to very large corporations. So it doesn't even apply to a lot of individuals, but some of the tax ramifications could affect individuals all over the spectrum, even those making less than $400,000. So although there's no specific tax directly impacting families making less than $400,000, as you can see that we're about to talk about, that some of these tax hitting corporations could indirectly affect these families.
That'll be interesting.
And so the first one you mentioned is the corporate minimum tax, which they also refer to as the business minimum tax. And this is one they've been lobbying around for years, wanting to go after corporations that show a lot of profit on their financial statements, but pay very little tax on their tax returns. And that's something that the press has loved over the years, to get hold of tax information on these large public companies. They're reporting billions of dollars in profits, but maybe show very little tax because of just some tax planning and timing differences in tax. So this tax imposes a 15% minimum tax on corporations that basically have over $1 billion in revenue. We can go a little more detail about that. But basically, you have some steps. You have to first determine who's an applicable corporation, how do you measure this tax, and when do they have to pay this tax? So Lisa can help me kind of go into more detail on this. But the first one we'll touch on is really, what is an applicable corporation this applies to?
Absolutely. And so, one of the things this is really set to get these big corporations that are out there. So it's a 3-year average of $1 billion of applicable financial statement income. And
you said billion with a
billion
B.
with a B with a B.
Yes.
And so, in true fashion here, we have created a new definition for what is financial statement income. So everybody's still trying to wrap their head around that piece, but it is $1 billion of income, 3-year average. So if you are foreign owned, there's a lower threshold that would make you subject to this. But for U.S. owned corporations, it's only going to affect a handful of entities.
And that's a good point to touch on, Lisa, because when you get into these foreign owned corporations, which, there's a lot of that in the press as well, it talks about that, the U.S. members only have to have $100 million of income as long as the overall group meets the $1 billion test. And some of the most complicated things in this bill is, what is a group determining the test, and who is this tax assessed on? Because there are two different items, really, because the group test is a larger test, but the tax then is only assessed on the smaller and possibly U.S. based entity.
Yeah, and I foresee that to be something that will impact financial statements, perhaps. And, there might be a reconciling schedule in the back of audited financial statements. As you know, audited financial statements have to disclose uncertain tax positions. So this could factor into auditors, understanding the risk of how a client has defined themselves in a group or taken a position on that. So this does have far-reaching impact outside of just simply preparing a tax return.
Exactly, because when you start looking at the testing, you look at the group, and the group can include partnerships that the corporation controls, et cetera, items like that. So it is very far-reaching. So this is an area that there are a lot of questions that are still out there. One is, as Lisa touched on, is you look at the test for the last 3 years, generally preceding the current year. What if you've only been in existence less than 3 years? Well, you just look at the number of years you've been in existence. So it can still apply to a newly established corporation. But again, the $1 billion test, that's generally going to be a company that's been around for a while to meet that test.
So, William, what about companies that maybe had a dip in their revenue because of COVID in 2020, and using that as part of your 3-year look back? Is this a test you have to do every year?
Yeah, you do it. You do basically do it every year, and you look at the past 3 years. So basically, it's looking at 2023. You look at your audited financial statements for 2021 and 22. Now, once a taxpayer is what they call an applicable corporation, this applies to you, it remains applicable for all future years. So you think about a corporation could have a big jump 1 year and hit it, over a 3-year average. Then even though they have a dip, let's say because of the recession, things fall down, or another COVID scare, they're still going to be subject to that tax, even on their lower earnings.
That's interesting.
So it's going to hit them. And of course, it says that, there's a parenthetical that says, unless Treasury provides an exemption. So that's going to be an area there's going to be a lot of lobbying about trying to get exemptions for that. And what happens when you split up a corporation or a spinoff? How do you determine that? So you can see all the questions that are there, because, you allocate it out to all the members. So, look at some of these spinoffs that have happened over the last year or two. How do you determine who that tax they would follow? So again, there are a lot of questions that are still kind of out there that really, people are really going to be struggling with.
Another point that is in the act is around stock repurchases, and companies oftentimes use that as a tax strategy, and that loophole was caught in this act. So can Lisa and William talk to us a little bit about how that is brought into the act and what our listeners need to know about that?
So the stock repurchases provision is a 1% tax on stock repurchases of public securities. And there's a lot of, like the corporate AMT, there's some new definitions, a lot of questions around what this will apply to, but they've released some statistics. And in 2021, the U.S. set a record for stock repurchases of almost 900 billion. So that's really what they're going after, is these large public companies that are repurchasing stock to possibly inflate stock prices. So they're just using this as another revenue raiser that they can go after the corporations.
The stock buybacks, again, as Lisa mentioned, is a 1% tax, and it's on public companies. But there has to be more than $1 million in buybacks. Which again, that's a small threshold for a large public company. Now, it doesn't apply to reorganizations, items like that, and so those can be exempted. Now, on this repurchase, you reduce it by stock issuances. So you look at it through the year. What were your buybacks less your issuances, and issuances can be your normal stock issuances. It can also be stocks that are issued in regard to employee plans, like stock option exercises, restricted stock, items like that. Also, any repurchases that are used to go into like an ESOP are exempted. But again, there are a lot of questions out there, and a lot of law firms have already reached out to Treasury saying we need guidance on this before the end of the year on how this is going to apply, when it comes into effect, because it does say there that this applies to any stock buybacks that are, quote, economically similar, close quote, to a
super specific.
Very specific. So it gives them it's kind of like that final catch-all of, well, it's up to their discretion what it applies to. Because again, you can have a lot of M&A transactions where, it could look like a buyback, bootstrap acquisitions, et cetera. And there's a lot of concern about preferred stock because a lot of times, that's the first stock that's repurchased. And a lot of people look at preferred stock basically as more like a fixed income instrument, and so people, generally has a set buyback price, et cetera. And what about when you have call features or mandatorily redeemable preferred stock? Issues like that, so there's a lot of uncertainty out there. And a final thing, just to touch on, these two items, the business minimum tax and the stock buyback tax. There's been some confusion out there about who it applies to, and we touched on that the business minimum tax is on those with the $1 billion threshold, and the buyback is only on those that are public companies. There's some confusion because the minimum tax, there's some literature out there that says that you have to be a public company for this to apply to. And that's not the case. You just have to meet this income test. Also, there was a lot of lobbying about who this applies to in private equity groups, et cetera. And there's been some exemption from that because a lot of private equity groups may be combined, may meet this test. So it's going to be interesting to see kind of how all this comes together.
And one thing also to kind of remember in both of these provisions is they don't take effect until 23. So there may be some activity towards the end of the year, just trying to push buybacks and do some transactions before the end of 22 so that we don't have to worry about these provisions.
Want to receive a monthly newsletter with wrap topics?
Then head on over to warrenaverett.com/the wrap and subscribe to our email list to have it delivered right to your inbox.
Now, back to the show.
Interesting stuff there on that. So let's switch gears to how this bill impacts individuals. I think I saw some credits for electric vehicles or more green energy tax provisions. Can you talk about that for a second?
Sure. So they extended the electric vehicle tax credit, but they made some modifications to it that are kind of interesting. First, in order to get the credit now, individual taxpayers have to have an adjusted gross income of $300,000 or less if they're joint filers, or $150,000 or less if they're a single filer. So it really limits, we do have the credit, but it does limit who can take them. Also, they limited how much the car could cost. So it's limited to electric vehicles that are under $55,000 MSRP for a car and $80,000 MSRP for a van, pickup, or an SUV. So it does cut out, a lot of the higher end electric vehicles out of this credit. The other thing is all the vehicles have to have final assembly occurring in the U.S. And so if you're buying a car, you've got to, not only do you have to meet the MSRP requirements now, but you actually have to make sure that the car was finally assembled in the U.S.
Yeah, and Lisa, there's some interesting provisions in there as well about the battery makeup and where the components came in from the battery. There's a lot of tests there. It can't come from China. And they're what they call also foreign entities of concern that they look at. And as you said, final assembly in the U.S. And so that's going to really fall on the manufacturers to be able to attest to that. That's not going to fall on, taxpayers to look at that. It'll just be, in their sales literature, whether it qualifies. And a couple other interesting things that came out of the bill, currently there's a limit on companies of I think it's 200,000 vehicles that once they meet that limit, they no longer qualify for any credit. So there's been some lobbying. So they got rid of that vehicle limit. So it's going to be unlimited now for the manufacturers, which is good. Also, you're going to be able to start, you can transfer the credit back to the dealer. So if you have a taxpayer that's maybe in lower income bracket, whatever, they really can't use the credit, they can sell it back to the dealer, basically if the dealer can use it, but that's something that's there. Also, they're also bringing into, starting in 2023, used electric vehicles. And it's interesting, the word electric is now gone. You have to refer to them as clean vehicle. That's now what it's called. They don't like the word electric, so it's now just going to be called clean. If you think about it, it just sounds better to the politicians. They're doing the clean vehicles.
Makes sense.
So so used ones will come into play starting in 2023. It has to be at least 2 years old, and it must be the first transfer of the vehicle. There's also lower qualifying dollar amounts of the car, and the qualifying vehicle is supposed to $7,500 for new vehicles. This is, the lesser of $4,000 or 30% of the sales price. Again, I said earlier that it's a $25,000 limit on the sales price anyway. So, a lot of issues there. And there are also, as Lisa mentioned, AGI limits. There are lower limits now on even the used vehicle purchases. Again, what should be simple, as you can see just from this limited discussion, is fairly complex when you start looking at who it applies to, when it applies, et cetera. So, expect a lot more literature out there, a lot more advertising. And again, this will fall on the person selling it, the companies, to basically have this information, be able to attest to the buyers that they qualify for this credit.
And there were some other green energy credits in there around more home ownership type credits.
So there are some home energy credits for doing energy efficient property in your home. They've had some of these around. They've been capped at $500 per taxpayer. Now there's a lifetime credit of $1,200 per taxpayer. So they do have them for putting, energy efficient, windows, doors, HVAC, those types of things. There's some solar credits, things like that they do have out there. But for residential, for an individual taxpayer looking to get a tax credit for their residence, it does cap out at $1,200 over the lifetime. So it is a credit and it's out there, but it's not going to be huge dollars.
Nothing of note, talking about these credits, as Lisa was just saying, that they've expanded those for, residential. They've expanded them a lot in the business arena. But another area they've done is the transfer of credits. And it allows taxpayers to transfer a portion or all or a portion of the credits, as long as it's to an unrelated party. And again, a lot of them are the business credits. Here's some exciting ones like the carbon oxide sequestration credit. I have no idea what that even means. Clean hydrogen production credit, clean electric production credit. It goes on and on, but it's a lot of these credits you see applied to businesses. So I think what you're going to see is probably a rise in the industry of brokers that are selling credits, because you can have a lot of these industries maybe that don't need the credit, so they'll package them up and sell them. So it'll be a way for businesses to get money and some taxpayers to get, some tax credits out of it. As far as a good investment.
Any other extended credits for individuals from the bill?
No, not really. There's really, like William said, there's a ton of business credits that are very specific credits out there, but there's not a lot for individuals. This is really a business credit heavy bill. So
I think I saw something on there about funding for the IRS. Can you all talk a little bit about what that relates to?
Yeah, that's one of the not the funniest things, but it's gotten a lot of press lately. A lot of attention because, they basically allocated $80 billion to go to the IRS for IRS enforcement. What's funny is before this hit, someone found an ad that was presented by the IRS. It was sent out looking for criminal investigation division agents, trying to get candidates. And it says you must be willing to use deadly force. And that just was kind of comical because it's like, how often does an IRS agent, do that? Plus, imagine being a taxpayer and knowing that that's out there.
Listen, William, accountants are very threatening.
They are.
We are very right threatening people.
Yeah,
people are scared of us.
If anybody saw the movie The Accountant, they'll know that. So basically it's for IRS enforcement, and they break that down by a lot of things they're supposed to do with that. One thing is they've allocated $15 million of that for the IRS to come up with to see about doing their own e-file system. That's interesting because, that's a very complicated thing to do. So it'd be interesting to see how that comes out. But right now the IRS is in such a bad place as far as PR and just where they are, just because a lot of it's because of COVID. They just got so behind, on processing returns. There are, long waits, a couple hours if you call. So, to the extent they can use this to work in those areas, I think that will go a long way.
What are some of the other provisions that were discussed in there that maybe we haven't touched on yet that you want the listeners to know about?
One thing that they did do at the last minute was they added in this extension on the limitation for excess business losses, which affects non-corporate taxpayers. So this is really one of the few business provisions that affects a non-corporate entity. And so, you have S corps and partnerships that, pass their income on to their owners. And this limitation came into effect back with the Tax Cuts and Jobs Act in 2017, and it was set to expire in 2026, and they actually extended it 2 more years, which if an individual taxpayer gets a business loss greater than $500,000, it actually gets suspended like a net operating loss and carried forward. So that provision is extended for 2 years now till 2028.
I think that's an interesting one to point out because, again, that can impact taxpayers under the 400,000, which,
Absolutely.
they were very clear. They're saying this will not impact taxpayers that make less than 400,000. Well, this right here is one that definitely can come into play. Another thing that there was a lot of lobbying, a lot of discussion out there about the carried interest legislation, meaning that they would, impose, tax on these carried interests that, a lot of, fund managers get in a way of, supposedly as compensation, but they get the favorable tax treatment on it. And that was basically a lot of lobbying went on right at the end of the bill being finalized, and that got pulled. So that was not in the final bill, but they had to do some trade-offs for it. Because one thing there was discussion about having in there about doing away with the SALT cap, the $10,000 limit on tax reductions for individuals. That was pulled to help pay for it as part of it. So it's interesting, we can almost do a whole podcast just on the lobbying and issues that went on behind the scenes and some of this legislation that may be more interesting to some of these listeners than what finally came out of it.
We may have to try to schedule that. We'll try to find somebody in Washington that wants to join us.
Yeah.
So as you know, William and Lisa, here on The Wrap, we always wrap it up in 60 seconds or less. So what would you like to leave the listeners with in regards to what they need to know about the Inflation Reduction Act?
I would just say, that has a lot of implications, but a lot of it's for large corporations as far as the tax increases. And you see a lot of these tax credits that are going to really be beneficial to the individuals. And so I think it's just going to be kind of wait and see. There'll be a lot more guidance that's coming out. And there are a lot more questions than answers right now. And so it's going to be, my view, just be patient and wait and see.
I agree. And I think that it is always look deeper into what you hear. Don't just take the sound bite, because chances are there's a lot more details behind it in this bill.
William, Lisa, it's a pleasure to always have you on the podcast, and we look forward to the next time you can join us.
Thank you, Lisa and William.
Thank you for having us.
Thank you.
And that's a wrap. If you're enjoying the podcast, please leave a review on your streaming platform.
To check out more episodes, subscribe to the podcast series, or make a suggestion of other topics you want to hear.
Visit us at warrenaverett.com/the wrap.